Welcome back to my weekly QQQ trade series. QQQ is currently trading just below $499 a share, and I'm Patricia Saylor, managing partner of Saylor Financial Fundamentals. Today, I'm aiming to generate a bit more income to boost my retirement. My $486 put from last week is out of the money and set to expire worthless at day's end. But for the covered call, we have a decision to make. Keep the same strike price for maximum income or roll it up to increase potential capital gains. Let's run the numbers and place some trades. On October 18th, I set up a cash secured put and a covered call, which are both expiring today. The cash secured put is out of the money, and if I choose the do nothing route, it will expire worthless. So I'll probably sell a new one. And the covered call has a strike price of $495 and is in the money. $495 is $5 a share higher than the price at which I was assigned to buy these shares. So even if I do a straight roll and keep the same strike price, I will still be selling these shares for a profit at $495. So let's make a decision about whether to keep the $495 strike price or roll it up to a higher number. So here's the position. You can see the put is almost completely out of extrinsic value. It's only going to cost me $450 to close it if I decide to do that. The covered call is in the money, and it's going to cost $441 to close it, $20 of which will be extrinsic value. So let's look at what the rolls could be. I'm looking at expiration dates for November 1st. So remember, I'm going to need to pay more than $400 to close it. So whatever I sell needs to bring in a significantly higher amount than that. So I could roll it straight out for $823. I could roll it up to $497.50 for $661, which would get me still a pretty good premium on the roll, and it would increase the strike price by $2.50. So let's look at a possible roll here. So I know that my new expiration date is going to be 7 days from now, November 1st. Keeping the same strike price, I could bring in at least $376. And if I increase the strike price by $1, I could bring in $308. If I increase it to $497.50, I could bring in $2.14, and the call would still be in the money. I'm going to look down here at the, I was going to look at the RSI, but I don't know that, oh, here it is, the RSI. It's kind of right here in the middle. It's very hard to predict which way the share price is going to move. So I think I'm going to roll it up a little, but still keep an in the money strike price. Let's look at 497. I'm going to roll it up $2 and bring in $2.45. Okay, that's great. It filled at $2.50, so let's enter the data on the spreadsheet. Okay, I used $495 as my collateral value because that is the amount that I would receive today if I opted to do nothing and accept assignment on this covered call. But even rolling it out, $248.68 is a 26.2% annualized return on the value that I am using to secure or using as collateral for this covered call. So now let's sell a new cash secured put. Since I just raised the strike of the covered call by $2, I'm comfortable doing the same with the cash secured put. Let's see if it brings in any meaningful income to take that choice. Okay, my current strike price is $486. keeping the same strike price, I could bring in another $146. And I think I'm going to go with the conservative route and the lower strike price. I thought about going up to 488 or even 490, but that just feels like more risk than I want to assume this week. So I'm going to keep the same 486 strike price and try to bring in about $145. And there it filled at 145. And let's do a quick expense and income sum and check our profit loss. And there it is, $5,432 in profits so far since last May, and I still own 125 shares. I'll see you next week, and we will continue to update this position and keep bringing in cash.